You guys know I'm Shannon Ellison, and today we're gonna break down two key metrics every real estate investor should understand, and that is cap rates and cash-on-cash returns, baby. Both are essential tools for making smart investment decisions, whether you're eyeing your first rental or scaling an entire portfolio. Let's dive in. So what is cap rate? The cap rate or capitalization rate measures the expected annual return on a property based on its net income. The formula is the NOI divided by the purchase price. Example, if a property earns $50,000 per year and costs $800,000, the cap rate is 6.25%. Well, Shannon, why does this matter? Cap rates can help compare properties in market areas. Higher cap rates may signal more risk, while lower cap rates often point to a more stable, premium locations. What is cash-on-cash return? This metric looks at your actual cash investment versus the cash flow that you receive. The formula is your annual pre-tax cash flow divided by total cash invested. Example, if you put $200,000 down and earn $20,000 a year in cash flow, your cash-on-cash return is 10%. And Shannon, why does that matter? This is your real-world ROI, showing how hard your dollars are working for you, factoring in financing and leverage. I know how crucial this is to understand those numbers before making any move. They can reveal if a deal is truly aligning with your financial goals. If you have more questions or want to analyze a deal together, reach out. I'm always available to help you invest wiser. Happy investing, and remember, it's about the numbers and the strategy. I'll see you next time.